I need you to pay very close attention to what I'm about to show you, because what just surfaced from China's silver vaults this week isn't making headlines, and that silence, that's exactly what worries me. We're watching a 70% price gap between physical silver in the East and paper contracts in the West. Dubai trading at $127 per ounce. COMEX showing $73. That's not a market correction. That's a market fracture. And when China controls 70% of the world's refined silver supply and suddenly tightens export restrictions, while COMEX inventories are bleeding out faster than anyone's willing to admit, you need to understand what's coming next. Because what I'm seeing in the data right now, welcome to Currency Archive. I'm glad you're here. Because this conversation requires your full attention. If you've been following financial markets long enough to remember when fundamentals actually mattered, when price discovery wasn't just a theory, then do me a favor. Hit that subscribe button. Not for the algorithm, but because intelligent analysis like this is becoming harder to find. And before we go further, drop a comment and tell me, where in the world are you watching this from today? I want to know who's paying attention while everyone else is distracted. Now, let me show you exactly what's happening behind closed doors in China's silver market. On a cold January morning in 2026, a senior procurement officer at a major electronics manufacturer opened his daily commodities report and stopped breathing for a moment. The number on his screen made no sense. Silver prices in Dubai were showing $127 per ounce. His supplier contracts, tied to COMEX futures in New York, were settled at $73 per ounce. He blinked. He refreshed the page. The numbers stayed exactly where they were. This was not a typo. This was not a temporary glitch. This was something far more serious. For the first time in modern commodity market history, the global silver market had fractured into two completely different pricing systems, and most people had no idea it was happening. In normal market conditions, when a commodity trades at different prices in different locations, something predictable happens. Traders notice the gap, they buy where it's cheap, they sell where it's expensive, the prices move closer together. This process is called arbitrage, and it has been the invisible hand that keeps global markets connected for centuries. A normal arbitrage spread in silver might be 2 to 5%. That accounts for shipping costs, insurance, storage fees, and a small profit margin for the trader doing the work. But 70%? That is not arbitrage. That is a market screaming that something fundamental has broken. When physical silver in Eastern markets trades at $127 per ounce, while paper contracts in Western exchanges settle at $73, the market is not having a disagreement. The market is having a divorce. The uncomfortable truth that institutional traders were whispering about in private was simple. Arbitrage had stopped working. And if arbitrage stops working, it means one of two things. Either nobody can move the physical metal from where it's cheap to where it's expensive, or there is no physical metal left to move. Both explanations were terrifying. The first explanation suggested that the global supply chain for silver had been severed. The second explanation suggested that Western markets were trading contracts for metal that did not actually exist in deliverable form. Neither scenario appears in the risk management textbooks that Treasury officers studied in business school. In January 2026, China controlled approximately 70% of the world's refined silver production capacity. Not mining, refining. That is a critical distinction. A mining company can pull raw silver ore from the ground in Mexico, Peru, or Australia. But turning that ore into the pure, standardized bars that industrial users actually need requires specialized refining facilities. And most of those facilities are located in China. When China implemented new export licensing requirements in January, the impact was immediate and surgical. It did not ban silver exports outright. It simply added administrative steps, paperwork, approvals, processing delays. On paper, this looked like routine regulatory adjustment. In practice, it functioned as a bottleneck that slowed the flow of refined silver from east to west to a trickle. Within weeks, physical premiums in Western markets began rising. Within a month, buyers in Dubai, Abu Dhabi, and Mumbai were paying prices that made COMEX settlements look fictional. To understand what was happening, one must understand how modern commodity markets actually function. There are two types of silver markets. Physical markets, where actual metal changes hands and gets delivered to vaults, factories, and storage facilities. And paper markets, where contracts representing future delivery of silver trade electronically on exchanges like COMEX in New York. For decades, these two markets moved in lockstep. The paper price reflected the physical price. Traders could convert between the two seamlessly. If you held a futures contract and wanted physical metal, you simply stood for delivery. If you held physical metal and wanted to sell, you delivered against a contract. The system worked because everyone trusted that the metal existed, that it could be moved, and that delivery would happen when required. In January 2026, that trust began evaporating. Buyers in physical markets were willing to pay $127 per ounce because they needed actual metal for manufacturing, for jewelry production, for solar panel assembly lines. They could not use a futures contract to build a product. They needed bars they could touch, weigh, and ship to their factories. Sellers in paper markets were offering contracts at 73 per ounce because those contracts did not require immediate physical delivery. They were financial instruments, bets on future prices. And as long as most holders closed their positions with cash settlement rather than demanding actual metal, the system functioned. But when the percentage of contract holders demanding physical delivery began rising, when registered COMEX inventory began falling faster than it could be replenished, when Chinese export restrictions prevented Western buyers from accessing Eastern supply, the entire mechanism seized. This was not a trading opportunity. This was not a chance to make quick profits on price divergence. This was a structural failure in one of the world's critical industrial commodity markets. And structural failures do not resolve themselves quietly. They resolve through forced liquidations, emergency rule changes, institutional losses, and supply chain disruptions that ripple through entire sectors. The question was no longer whether prices would converge. The question was which price would survive. The trading floor veteran had seen 3 decades of commodity markets. He had lived through the 2008 financial crisis. He had watched oil go negative in 2020. He had seen wheat markets lock limit up during geopolitical shocks. But what he was watching unfold in the silver market in early 2026 was different. This was not panic. This was not speculation. This was not even a squeeze in the traditional sense. This was a slow-motion realization that the warehouse receipts everyone had been trading might not be backed by metal that could actually be delivered. The inventory that disappeared in silence. COMEX operates with 2 categories of silver inventory, eligible and registered. Most market participants do not understand the difference until it becomes critical. Eligible inventory sits in approved warehouses. It meets quality standards. It could theoretically be delivered against futures contracts, but it has not been officially designated for delivery. Think of it as metal that is nearby, available but not yet committed. Registered inventory is different. This is metal that has been specifically earmarked for delivery against futures contracts. This is the metal that actually backs the paper contracts trading on the exchange. Throughout 2025, analysts noticed something strange. Eligible inventory remained relatively stable, but registered inventory was bleeding out at an accelerating pace. In January 2026, registered silver at COMEX stood at approximately 42 million ounces. 5 years earlier, that number had been over 120 million ounces. The metal was not being consumed, it was being withdrawn, systematically, quietly, by parties who were converting paper promises into physical possession. The mathematics of delivery failure. Here is where the story becomes uncomfortable for institutional risk managers. At any given time, COMEX has open interest representing hundreds of millions of ounces of silver. These are contracts held by traders, banks, hedge funds, and institutional investors. Historically, only a small percentage of contract holders ever demand physical delivery. Most close their positions before expiration. They settle in cash. They roll contracts forward. The system works as long as this pattern continues. But in early 2026, delivery notices began spiking. Except this time, there was no single Hunt Brothers figure to blame. This time the accumulation was distributed, institutional and global. When a commodity exchange has 50 ounces of paper claims for every 1 ounce of deliverable physical inventory, it is not operating as a commodity market. It is operating as a fractional reserve system, and fractional reserve systems fail the moment confidence breaks. The emergency measures that revealed the problem. In late January, COMEX announced a routine adjustment to margin requirements for silver contracts. Traders needed to post more collateral to hold the same positions. The official explanation was standard risk management. Volatility had increased. Margin requirements needed to reflect that reality. But experienced traders understood what they were actually witnessing. This was not risk management. This was demand destruction. When margin requirements increase, smaller traders get forced out, positions get liquidated, open interest declines, and most importantly, the number of potential delivery demands decreases. This is the equivalent of a bank that is running low on cash, suddenly making it harder to withdraw money. The policy sounds reasonable in isolation, but the timing reveals the desperation. The margin increase did slow delivery demands temporarily, but it also confirmed what sophisticated market participants had suspected. The exchange could not handle physical settlement at current contract volumes. The banking sector's hidden exposure. What most business professionals do not realize is that major banks are not just facilitating silver trades. They are counterparties to massive derivative positions tied to silver prices. These derivatives include options, swaps, structured products, and customized contracts for corporate clients who use silver in manufacturing. When silver prices become violently unstable, when the gap between physical and paper prices creates valuation uncertainty, these derivative books become impossible to hedge properly. A bank that sold price protection to an industrial silver consumer at 73 per ounce now faces a client who cannot actually source physical metal at that price. The client needs silver at $127 to keep production running. The derivative contract says $73. Someone is going to absorb a catastrophic loss. This is not theoretical risk. This is balance sheet risk. And it was multiplying across the institutional sector faster than risk committees could model it. The precedent that everyone was ignoring. In March 2022, the London Metal Exchange halted nickel trading after prices exploded from $30,000 per ton to over $100,000 in hours. Positions were canceled retroactively. Billions in trades were voided. The official reason was market integrity. The actual reason was that the exchange faced member defaults that would have destroyed the institution itself. Silver in early 2026 was following a similar trajectory, just slower. The price gap was widening. Delivery demands were increasing. Registered inventory was depleting. Margin requirements were rising. Every emergency measure taken to stabilize the market actually confirmed that stabilization was no longer possible through normal means. The question that changed everything. A risk analyst at a European bank asked his team a simple question during a January strategy meeting. If we cannot source physical silver to deliver against our client commitments, what exactly are we selling? The room went silent, because the honest answer was they were selling promises backed by other promises, backed by contracts, backed by warehouse receipts, backed by assumptions that had stopped being true weeks ago. The plumbing had failed, the arbitrage had broken, the inventory was gone, and the institutional sector was just beginning to understand how exposed they actually were. The mining executive from Australia thought he understood global commodity flows. His company had been shipping silver concentrate to Chinese refineries for 15 years. The relationship was professional, profitable, and predictable. Then, in the second week of January 2026, his primary buyer in Shenzhen sent an email that changed everything. The message was polite, almost apologetic. New export licensing procedures were being implemented. Refined silver shipments to non-Chinese destinations would experience administrative delays, perhaps 4 weeks, maybe 6. The timeline was unclear. What was crystal clear was the implication. The silver is company mined in Australia, shipped to China for refining, and sold to European manufacturers was no longer following that route. The metal was going in, but it was not coming back out. The refinement chokepoint, nobody discussed. Most business analysts focus on mining production when evaluating commodity supply. Who digs the most metal out of the ground? Which countries have the largest reserves? But with silver, the critical question is different. Who can turn raw ore into the standardized high-purity bars that industrial users actually need? The answer, overwhelmingly, is China. Approximately 70% of the world's silver refining capacity sits within Chinese borders. This did not happen by accident. It happened through decades of strategic industrial policy, environmental regulation arbitrage, and capital investment in processing infrastructure that Western nations abandoned. A Mexican mining company can extract silver from the earth, but without access to Chinese refineries, that ore cannot efficiently become the 99.9% pure bars required for electronics manufacturing, solar panel production, or institutional vault storage. This is the difference between controlling resources and controlling processing. China had quietly secured the latter, while Western analysts obsessed over the former. The export license that was not really a ban. On January 6, 2026, China's Ministry of Commerce issued a technical update to export licensing requirements for refined precious metals. The language was bureaucratic and unremarkable. Companies seeking to export refined silver would need additional documentation, environmental compliance certificates, proof of origin for raw materials, enhanced customs declarations. On paper, this was regulatory housekeeping. In practice, it was a valve being slowly closed. Applications were not denied. They were delayed, pending review, awaiting approval from departments that operated without published timelines. The metal sat in bonded warehouses near ports, technically cleared for export, administratively frozen in place. Western manufacturers, who relied on Chinese refined silver for production schedules, found themselves in an impossible position. Their orders were confirmed, their payments were processed, but their shipments were not moving. A German automotive supplier described the situation to his board in February. We are not being told no. We are being told later, and later keeps becoming later. The strategic reserve that nobody could verify. Intelligence analysts in Washington and London had been tracking Chinese precious metals accumulation for years, but the data was fragmented and contradictory. Official Chinese government reserves reported modest silver holdings, but state-owned enterprises, provincial development funds, and policy banks were purchasing silver through channels that did not appear in central bank disclosures. A former commodities trader who had worked in Shanghai explained the structure to a financial journalist. You are looking for one big vault with a sign that says National Silver Reserve. That is not how China operates. The accumulation is distributed across hundreds of entities that are technically independent but strategically coordinated. By early 2026, Western intelligence estimates suggested China controlled between 400 million and 600 million ounces of refined silver across various institutional holdings. If accurate, this represented more physical silver than existed in all registered COMEX and LBMA inventories combined, but nobody could verify the number, and that uncertainty was, strategically, the point. The industrial dependency that became leverage. Solar panel manufacturers face the most immediate crisis. Modern photovoltaic cells require silver paste for electrical conductivity. There is no commercial scale substitute that matches silver's performance characteristics. China produces approximately 80% of the world's solar panels. Those production lines consume enormous quantities of silver. When Chinese refineries slowed exports, they were not cutting off their own industrial base. They were cutting off competitors. A solar company executive in Arizona described the situation bluntly during an earnings call. We have 6 weeks of silver inventory. Our Chinese competitors have secured domestic supply. We are now negotiating to buy finished panels from the same companies we were competing against last quarter. Electronics manufacturers faced similar dynamics. Automotive suppliers struggled with circuit board production delays. Medical device companies scrambled for alternative sourcing. The pattern was consistent. Industries dependent on silver found themselves dependent on Chinese supply chains that were no longer operating under market principles they recognized. The Indian response. That revealed Eastern strategy. India, the world's second largest silver consumer, responded to Chinese export restrictions with panic buying. Import data from January and February 2026 showed Indian silver imports surging to levels not seen in decades. Premiums over COMEX prices in Mumbai reached $30 to $40 per ounce. But where was India sourcing the metal? Not from China, from recyclers, from secondary markets, from private holders liquidating old positions. This was not new supply entering the market. This was existing above-ground supply being reallocated at dramatically higher prices. A metals trader in Dubai observed, "The East is not waiting for Western markets to resolve their paper versus physical problem. The East is building a separate pricing mechanism based on what metal actually costs when you need delivery tomorrow." The Middle Eastern market. That became the new benchmark. Dubai's gold and silver souk had always been a significant physical trading hub. But in early 2026, it transformed into something more important. A price discovery mechanism independent of COMEX and LBMA. Buyers from Europe, Africa, and Central Asia, who could not access Chinese supply and did not trust Western exchange pricing, began using Dubai spot prices as their reference point. At $127 per ounce, these were not speculative prices. These were the actual transaction prices for metal that could be verified, inspected, and shipped within 48 hours. A Swiss refinery manager explained the significance. For the first time in my career, I am seeing corporate buyers willing to pay Middle Eastern physical premiums rather than COMEX futures prices. That means they no longer believe COMEX represents reality. The bifurcation that could not be reversed. By late February 2026, the global silver market had effectively split into two separate ecosystems. And the Eastern physical market, where metal traded at $127 per ounce and delivery was immediate. The question was no longer if these prices would converge. The question was which system would collapse first. The chief risk officer at a New York investment bank sat across from his legal team in a windowless conference room. The question on the table was not theoretical. It was existential. If we cannot deliver physical silver against our contractual obligations, what are our actual legal exposures? The lead attorney flipped through contract language that had been standard boilerplate for 30 years. Force majeure clauses, market disruption provisions, settlement alternatives. Then he looked up and said the words nobody wanted to hear. These contracts were written assuming functional markets. We are no longer in a functional market. By March 2026, institutions across the financial sector were having variations of this same conversation. The silver market fracture was no longer a pricing anomaly to monitor. It was becoming a settlement crisis that demanded immediate strategic response. Scenario Alpha, the forced cash settlement. The first resolution pathway being quietly discussed in institutional corridors was forced cash settlement of physical delivery contracts. COMEX had the regulatory authority to declare a delivery emergency. Under such a declaration, contract holders demanding physical silver could be forced to accept cash settlement at exchange-determined prices instead of actual metal. This had precedent. During the 1980 silver crisis, position limits were imposed retroactively. During the 2022 nickel squeeze, the London Metal Exchange canceled trades that had already executed. Exchanges can change rules when institutional survival is at stake. But forced cash settlement created a different problem. At what price? If COMEX forced settlement at $73 per ounce, while physical markets traded at $127, every contract holder would have legal grounds to claim damages equal to the difference. The lawsuits would be immediate and astronomical. If COMEX forced settlement at physical market prices, it would be admitting that exchange pricing had been fictional. The reputational damage would destroy confidence in every other commodity contract the exchange offered. A derivatives attorney explained the dilemma. They can force cash settlement, but they cannot force acceptance of a settlement price that is demonstrably disconnected from physical reality. Someone is going to absorb massive losses. The only question is who. Scenario beta, contract specification, modifications. The second pathway involved modifying futures. Contract specifications to reduce delivery pressure. COMEX could increase the size of deliverable bars, change purity requirements, or expand the list of acceptable delivery locations to include vaults in jurisdictions where physical supply was more accessible. These changes would make it technically easier to deliver against contracts, but they would also fundamentally alter what the contracts represented. An institutional silver buyer described the problem. If I hold a contract that promises delivery of London, good delivery bars in New York, and the exchange changes the rules to allow delivery of different specifications in different locations, I am no longer holding the same financial instrument I purchased. Contract modifications of this magnitude would trigger accounting reclassifications, hedge ratio adjustments, and potential margin calls across the entire derivatives complex. Worse, it would signal that the exchange was changing rules to protect itself rather than maintaining contract integrity. And once that precedent was established, every futures market became subject to mid-game rule changes whenever institutional stress emerged. The cure might be worse than the disease. Scenario gamma, government intervention and strategic release. The third scenario involved Western governments treating silver as a strategic resource requiring official intervention. The United States maintains a national defense stockpile that includes various strategic materials. While silver holdings are modest compared to Cold War levels, emergency release protocols exist. European nations could coordinate releases from central bank holdings and government reserves. A coordinated Western strategic release of 50 to 70 million ounces might temporarily ease physical market tightness. But this approach faced immediate complications. First, it required admitting that market mechanisms had failed so completely that government intervention was necessary. That admission would trigger broader questions about commodity market integrity across all exchanges. Second, strategic releases are meant to address temporary supply disruptions, not structural market fractures. If Chinese export restrictions remained in place, any government release would be absorbed quickly without resolving the underlying supply-demand imbalance. Third, once governments became active participants in price suppression efforts, they became targets for every lawsuit, investigation, and political challenge related to market manipulation. A former Treasury official who had worked on strategic petroleum reserve policy put it simply, government intervention in commodity markets is a tool of last resort. It means every other mechanism has already failed. And once you deploy it, you own every problem that comes after. Scenario delta, permanent market bifurcation. The fourth pathway was the one nobody wanted to acknowledge, but everyone was privately preparing for. Acceptance that the global silver market had permanently fractured into separate regional pricing systems. The Eastern physical market, anchored by Chinese supply control and Middle Eastern price discovery, would operate at significantly higher price levels. The Western paper market, anchored by COMEX and LBMA, would continue trading contracts at lower prices with increasing reliance on cash settlement and decreasing physical delivery. Industrial users would source metal from whichever market they could access, paying premiums that reflected actual supply availability rather than exchange pricing. This was not a resolution. This was an acknowledgement that resolution was impossible under current structures. A commodity strategist at a European bank described the implications. We are watching the birth of a two-tier system, paper silver for financial speculation, physical silver for industrial necessity, and never the two shall meet again. The historical precedent that everyone was studying. In 1968, the London gold pool collapsed after central banks could no longer maintain the official gold price of $35 per ounce against market demand. The resolution was not a return to the previous system. The resolution was abandonment of the official price and transition to a free-floating market mechanism. The institutions that had promised to maintain the peg simply stopped trying. The price discovered its own level. Holders of old contracts were settled under terms that nobody would have accepted had they known those terms in advance. Silver in 2026 was following a similar trajectory. The question was not whether the current system would survive. The question was what would replace it and who would bear the losses during transition. The institutional adaptation already underway. By March, sophisticated institutions were not waiting for official resolution scenarios. They were adapting to the reality that had already emerged. Treasury departments were rewriting procurement contracts to specify physical delivery premiums independent of exchange pricing. Risk management teams were separating paper silver exposure from physical silver requirements in their hedging models. Corporate buyers were establishing direct relationships with refineries, recyclers, and secondary market dealers to secure supply outside traditional exchange mechanisms. This was not panic. This was pragmatic adjustment to a market structure that no longer functioned as designed. The question that had no good answer. In late March, a financial journalist asked a veteran commodity trader the question that summarized the entire crisis. How does this end? The trader paused for a long moment before responding. It ends when institutions stop pretending that paper contracts and physical metal are the same thing. It ends when exchanges admit their delivery mechanisms cannot support the contracts they issue. It ends when governments decide whether commodity markets are critical infrastructure requiring intervention or private sector problems that will resolve through defaults and litigation. He paused again. Or it ends when China decides how much of the world's silver supply they want to control permanently. Because right now, they are the only party in this crisis who is not losing. The market fracture that began as a pricing anomaly had become a structural transformation. The institutions that built their business models on paper-physical equivalents were facing a reality where that equivalence no longer existed. Resolution was coming, but resolution would not restore the previous system. Resolution would formalize the new reality that Eastern physical supply and Western paper contracts now operated in separate universes. And everyone with exposure to either system needed to decide, very quickly, which universe they actually needed to survive in.